From the following information, calculate price earning ratio. What is the formula for price earning ratio? Earnings available to market pricing ratio, market price per share divided by earning per share. Yeah. So equity share capital rupees 10 each, 8 lakhs. 9% preference shares 10 each, 3 lakhs. Profit after tax 38%, 2,67,000. Depreciation 67,000. Market price per share 48. Market price per share 48 rupees 48. Okay. Based on that, we have to compute price earning ratio. Formula for price earning ratio: market price per share MPS divided by EPS. So MPS given in this question 48 divided by EPS. You have to compute EPS only. With respect to EPS, available data and net profit is there. How much net profit? Net profit after tax is how much? 2,60,000. Less preference dividend is equal to earnings available to equity shareholders. Preference dividend is how much? 10% on 30,000, 3 lakhs is equal to, sorry, 9% on 3 lakhs is equal to 27,000. Therefore, 2,67,000 minus 27,000 is equal to 2,40,000 divided by number of shares 80,000. Clear? Therefore, EPS 3. So 40 divided by 3 is equal to MPS. Answer 16 times. Are you able to follow? Good. Next. Equity multiplier allows the investor to see what portion of interest on debt can be covered from earnings available to equity shareholders. How many times preference shares interest be paid from earnings available to equity shareholders. C, what portion of return on equity is result of debt. And D, how many times equity share is multiplied to get value of debt. So what is the right answer? The answer is what portion of return on equity is the result of debt. Answer C. Yes. 10. A company, next question. A company has average account receivable of rupees 10 lakhs and annual credit sales of rupees 60 lakhs. Its average collection period is how much? What is the formula for average collection period? 365 divided by debtors turnover ratio. So you have to compute debtors turnover ratio. What is the formula for debtors turnover ratio? Credit sale divided by average debtors. Credit sales, we have to assume all the sales made under credit. Right? Credit sales given in this question. How much? 60 lakhs divided by average debtors 10 lakhs. Therefore, 6. Yeah. 10. 365 divided by 6 is equal to 60.8. Here the answer.
Yes.
Answer A. A is answer. Next. A company has a net profit margin of 5% on total sales of 9 lakhs and return on asset of 9%. Its total asset turnover ratio would be how much? What is the formula for asset turnover ratio? Total asset divided by turnover divided by total asset. Turnover nothing but sales. How much the sales? Net profit margin 5%. Total asset 9 lakhs. Return on asset 9%. Listen here. Total asset 9 lakhs. Return on asset is how much? 9%. 9 lakhs into 9% is equal to how much? 81,000 net profit. Clear? 81,000 net profit is equal to how much percentage? 5%. Upper total sales all over. That's logic or not? So 9 lakhs into 9% is equal to net profit in rupees divided by net profit percentage 5% is equal to how much? Kanna? No, this is the answer. 16 lakhs 20,000. 16 lakh 20,000 divided by assets all 9 lakhs is equal to 1.8. Okay, 1.8. Are you comfortable? 16 lakh 20,000 by 9 lakhs. Any difficulty? C is the correct answer. Reverse by way of calculator, you have to compute in exam based on the available data. Okay. Next, what does quick ratio measures? Relationship between market value and book value per equity shares, portion of profit available per equity shares, overall earnings on average total assets, market value of equity as well as debt in comparison to all assets in their replacement cost. What is the right answer? Market value of equity as well as debt in comparison to all assets in their replacement cost is called Q. Next, calculate operating expenses. We did the problem just now, right? Operating expenses. Calculate operating expenses from the following given information given below. Sales 75 lakhs, rate of income tax 50%, net profit to sales 5%, cost of goods sold 32 lakh 90,000, interest on debenture 60,000. Archana has to tell the answer. Correct. Operating expense how much? Pick, right? Over. Then put it in calculate. क्या हुआ? May I help you? Okay. P&L mark draft பண்ணிக்கோ workingல. Credit side sales எவ்வளவு போட்டுக்கோ? Triple X skip it. How many lakhs? 75 lakhs sales credit side ல. இல்லடா கண்ணா? Cost of goods sold எவ்வளவு? Debit side ல. 32 lakhs. Cost of goods sold comes to 32 lakhs 9,000. Therefore GP எவ்வளவு? Gross profit 75 lakhs minus 32 lakhs. 42 lakh 10,000. Clear kana? GP brought down. Am I right? 42 lakhs 10,000. 10. So GP brought down. Okay, brought down 42 lakh 10,000. Debit side net profit how much kana? Net profit 3.3 lakh 75,000. Interest all of them 60,000. Tax 50% tax all over same 3.75. Am I right? After tax net profit 3.75. Upper balance tax all over balance amount. Tax also 3.75. Are you able to follow or not? 3.75 is a tax also. Therefore 42.10 minus 3.75 net profit minus 3.75 tax minus interest 60,000. Balance equal to operating expenses. Net profit will not form part of operating expenses. Next, tax is not form part of operating expenses. Interest finance expenses. அது remove பண்ணா balance equal to what? எவ்வளவு வருது? 34 lakhs. புரிஞ்சுதா கண்ணா? புரிஞ்சுதா? சேச்சி புரிஞ்சுதா? Next. Which of the following is not a proprietary ratio? Price earning ratio, sorry, profitability ratio, price earning ratio, return on capital employed, Q ratio, and preferred dividend coverage ratio. What is not to கேக்குறான்? Okay. Everything profit is there, whereas D, preferred dividend coverage ratio, is not a profitability ratio. So answer D. That's all.